Your goals for retirement won't magically materialize if you don't put in the work. You'll need to get a head start on your savings if you want to enjoy the kind of comfortable retirement you envision for yourself. If you're new to investing, getting a company retirement plan has the potential to be one of the most beneficial things to help you build a secure financial future for yourself. An employer-sponsored 401k plan is one of the most effective ways to save for your own retirement and ensure your financial stability in the years ahead. If you don't take advantage of it, you might just end up missing out on a fantastic opportunity to save for retirement while also reducing the amount of tax you have to pay on the savings you make. Welcome to Money Talk, where we discuss tips on making money. In this video, we are going to talk about the 401k plan. What is it all about? And why you need one. But before we begin, don't forget to hit that like button, hit subscribe, and click that notification bell to receive updates and be the first to check out our latest videos. What is a 401k plan? A 401k is a savings and investment plan for retirement that many firms make available to their employees. Employees who contribute to a 401k plan receive a tax discount on that money. Employee contributions are deducted from their paychecks on a regular basis and placed in investment vehicles of the employee's choosing, and from a list of available offerings. In 2022, the maximum amount that can be contributed to a 401k each year is capped at $20,500 or $27,000 for participants age 50 or over. The portion of the Internal Revenue Code, notably subsection 401k, was responsible for the establishment of this plan and is also where the snappy name originates from. When an employee enrolls in payroll deductions, money is taken out of their paycheck and deposited into their own personal savings account. When you make contributions to your plan, or when you take money out of it in retirement, you may be eligible for a tax break depending on the type of plan you have. How can one get a 401k? Your employer will provide you with your 401k plan. Unfortunately, not all employers offer a 401k plan. Don't give up. You can still get the same tax breaks from an individual retirement account, which is the other big way to save for retirement. This may lead one to ask the question, what exactly is an IRA? The IRA, or Individual Retirement Account, provides a number of benefits, such as a wider range of investment options and generally reduced costs, but with some drawbacks like the lower contribution limits and restrictions for high earners. What are the benefits of the 401k can provide? A lot of employers will offer to match some of what you save. This employer match is the 401k perk that everyone talks about. If you work somewhere that will offer to add extra money to your account based on how much you put in, like a dollar for dollar or 50 cents on the dollar match up to, or maybe 6% of the amount you put in, waste no time and start filling out that paperwork. Even if you don't do anything else, make enough contributions to your account to get that free money. There are many kinds of 401k plans, but the two most popular are the traditional 401k and the Roth 401k. The traditional 401k gives you a tax break right away on the money you save. When you put money into a Roth 401k, you use money that has already been taxed. This means that you can't deduct the money from your taxes for that year. Contributions made before taxes make saving somewhat less unpleasant. Contributions to a standard 401k plan are deducted from your salary before the IRS takes its share, which magnifies each dollar saved. Let's say you usually pay 20 cents in taxes for every dollar you earn. If you don't have a 401k, you need to make $1,000 a month to save $800 a month. And that's $800 plus $200 to cover the IRS's cut. Your taxable income could be greatly reduced if you make contributions. Pre-tax contributions to a standard 401k plan increase the amount of money you are able to save. But They can also reduce the amount of money that is subject to taxation for the entire year. Let's pretend that you have an annual income of $65,000 and contribute $19,500 to your 401k. You will only be responsible for paying income taxes on $45,500 of your wage rather than the full amount of income, which is $65,000. In other words, by setting money aside for the future, you can avoid paying taxes on an additional $19,500. Your money in the account grows without any problems. Once money is in your 401k, there is a force field around it that keeps it from being taxed. Both traditional and Roth 401ks are the same in this way. As long as the money stays in the account, any investment growth is not taxed. Not on dividends, not on any gains from investments, and not even on interest. Not for long though. The fact that a traditional 401k doesn't have to pay taxes doesn't last forever. Remember, when the money you put into the plan let you get a tax break? Well, the IRS will come back at some point to take a cut. Technically, your contributions and the growth of your investments are tax deferred. This means that you don't have to pay taxes on them until you start making money out of the account. This is where the Roth 401k shows its special power. A Roth 401k plan eliminates the need to worry about paying taxes immediately. The Roth 401k provides the same protection from taxes on your investments while they are held in the account. There is no additional tax liability to the Internal Revenue Service on the money as it grows. When you start taking distributions from a Roth 401k, you won't owe any money to the Internal Revenue Service. This isn't the case when you take qualifying withdrawals from the traditional 401k. What precisely does that mean? Do you remember what we said earlier about how depending on that kind of 401k plan you have, you can get a tax reduction when you make contributions or when you take money out on retirement. However, the Internal Revenue Service can only charge you with income taxes once. Because your contributions to a Roth 401k were made with post-tax dollars, you will not be required to make any payments until the retirement account is fully funded. Therefore, when you start withdrawing money from your retirement account, the debt has already been paid. You can take it along with you. You have the option and the responsibility to take your 401k savings with you if you ever decide to leave your current employer for another one. You will need to roll that account into your new employer. And for many people, changing that 401k to an IRA is a terrific option. This will not be placed in a box with your other items. When the time comes for you to roll over your 401k, you can always go back to this video for advice. One of the most important parts of accumulating wealth and ensuring one's financial security is the practice of saving money. There are a number of easy ways to do it, which includes the topic we talked about today. By saving money, you may avoid many difficulties in life by setting money aside on a regular basis. Your family will have something to fall back on if the worst happens, and you can rely on it when you least expect it. By saving up, you'll be able to enjoy a better quality of life in the future. If you enjoyed this video, make sure to hit that thumbs up button, click subscribe, and hit the notification bell to receive updates on our latest videos. And also, feel free to leave us a comment. If you want to watch more videos, head on over to our channel to see more from Money Talk. See you!